In the bonus section, and we've mentioned this a few times, but I think it's a timely reminder. Emerging markets in general are really cheap compared to the US, but we do know there's a strong correlation between markets. So if the US blows up, then everything else is most likely going to fall, right? So again, it's always a good idea to keep some cash against each investment. So, you've got a means there. If you're buying something that's already cheap, doesn't mean it can't fall more. And if you've got some cash sitting there, then you get a little bit closer to, your buy price will then come down. Yeah. You'll be a bit closer to the actual price and you'll do better.
Yeah. You don't want to, if you buy a stock at $1 and it falls to 80 cents, what I think you want to do is you don't want to get your price too far away from the current price.
Yeah, you want to get as close to the 80 cents
you want to
as
stay.
possible.
And that generally is sort of like dollar cost averaging. My argument is, well, what you want to do is if it's $1 and it falls to 60 cents, right? You're going, oh man, I'm down 40%. And you've got to go down 40 means you've got to make 80% to get back to where you were, right? Or something like that. What you do is you say, all right, well, I'll buy more at 60 cents and I'll drop my original dollar price will now be 78 cents. So now I'm only, 18 cents away rather than 40 cents. Yeah. Right? And that's really good with ETFs.
Yeah.
Right.
Well, the issue is what I did was I tried to do that with my penny stocks and then run out of cash.
Yes.
So it went from $1 to 50 cents to 40 cents to 30 cents and then boom, it was gone.
Yeah.
And then I sold out and lost everything.
No method to the madness, mate.
No. But to your point with ETFs, you lose one.
Perfect.
You lose one out of the ETF bucket and it doesn't matter because the rest of it, in time, your asset allocation and your rebalancing will sort itself out.
Individual stocks can go to zero, or if they can't go to zero, they can stay low for a long time.
Yeah.
Right? Whereas ETFs generally are more safe. It doesn't mean you'll make a mozza, but what it means is you've got a better probability of recovering your losses.
And like we said, you can make a mozza.
Absolutely.
And if you pick a good one, you're going to get a decent dividend.
Yeah.
So even if the capital price has dropped a little bit, but you've, through rebalancing, stayed pretty close to the spot price, and you've also pulled an income from it, that's how you're going to make good returns.
People are getting onto that now. There's a lot more stuff about ETFs, where people are cottoning on to the idea that it's a better way than trying to pick individual stocks.